It is late February 2026. You come home from another exhausting day at work. The sky is already dark, the winter air is freezing, and you are carrying the mental weight of a dozen different problems. You walk up to your mailbox, open the little metal door, and pull out a stack of junk mail. Most of it goes straight into the recycling bin, but there is one envelope you have to open. It is the renewal notice from your car insurance company. Geico, State Farm, Progressive, Allstate. It does not matter what logo is on the envelope. Because right now, they are all playing the exact same game. You rip it open, expecting the usual slight bump. Maybe $5 more a month. Annoying, but manageable. You unfold the paper, your eyes scan down to the total premium due, and your brain suddenly stops processing information. You blink, you look again, you rub your eyes, thinking the exhaustion is making you hallucinate. But the ink on the paper does not change. Your 6-month premium hasn't just gone up, it has doubled. You were paying $150 a month, and now they are asking for $300 a month. $3,600 a year just for the legal privilege of driving your own car to the job that barely pays you enough to survive. A cold wave of panic washes over you, quickly followed by a hot, blinding rage. You immediately start reviewing your own life. Wait, did I get a speeding ticket? No. Did I back into a pole at the grocery store? No. Have I filed a single claim in the last 5 years? Absolutely not. You drive a boring, reliable 2018 Honda Civic. You stop at yellow lights. You park in the back of the lot to avoid door dings. You have been a perfectly obedient, profitable customer for half a decade. You have paid them thousands of dollars and asked for nothing in return. So why are you being punished? Why are they treating you like you just crashed a Ferrari into a school bus? You feel a knot tightening in your stomach because you realize a terrifying truth about living in America in 2026. Driving is not a luxury. In 95% of this country, if you do not have a car, you do not have a job. If you do not have a job, you do not have a home. The insurance companies know this. They know they have a monopoly on your physical mobility. They are holding your ability to survive hostage, and they just doubled the ransom. I am Ben, and today we are going to talk about the most infuriating silent robbery happening in the US economy right now. We are going to put down the macroeconomics textbook and look at the immediate bleeding wound in your checking account. We are going to expose exactly why your car and home insurance premiums are skyrocketing while your coverage is shrinking. But more importantly, we are not going to just sit here and complain about it. I am going to give you the exact tactical blueprint, the specific phone scripts, and the mathematical formulas to fight back and claw your money out of their greedy hands this week. To beat the enemy, you first have to understand the scam. Let's diagnose the trap. If you call your insurance agent right now and ask them why your bill doubled, they will read from a corporate script. They will use words like inflation, supply chain disruptions, and increased severity of claims. They will tell you that the cost of used cars went up, so the cost to replace them went up. They will tell you that the new electric vehicles, the Teslas and the Rivians, are so complex that a minor fender bender requires a $20,000 battery replacement, driving up the costs for everyone. They will paint a picture of an industry struggling to survive in a harsh economic climate. They will act like they are victims of the economy, just like you. Do not believe a single word of it. It is a smokescreen. Yes, parts are more expensive. Yes, EVs are a nightmare to fix. But let us look at the reality they hide in their quarterly earnings calls. While they are sending you letters demanding double the premium, these exact same insurance conglomerates are reporting record-shattering multi-billion-dollar profits to Wall Street. They are authorizing massive stock buybacks. They are paying their CEOs $50 million bonuses. They are spending billions sponsoring football stadiums and running television commercials with talking geckos and quirky cashiers every 5 minutes. Does that sound like an industry that is struggling to make ends meet? The reality is that insurance companies are not in the business of fixing cars. They are in the business of collecting capital. Warren Buffett, who owns Geico, built his entire empire on a concept called the float. The float is the massive pool of money that customers pay in premiums every month before any claims are paid out. The insurance company takes your $300 a month and they invest it in the stock market, in bonds, in real estate. For the last 2 years, with interest rates hovering near 4% and the stock market hitting all-time highs, their investment portfolios have been printing money. They are richer than ever. So why are they raising your rates? Because they can. Because the algorithm told them to. In 2026, you are not a human being to an insurance company. You are a data point in a predictive AI model. They do not care about your clean driving record. The algorithm looks at your zip code. It looks at the crime rate in your city. It looks at your credit score. It looks at the number of uninsured drivers in your state. The system collectivizes the risk, but privatizes the profit. That means if a teenager down the street totals his Mustang, your rates go up to subsidize the payout. If a hailstorm hits a town 50 miles away, your home insurance goes up to cover the roof replacements. You are paying for the mistakes of strangers. And the AI has calculated exactly how much pain you can tolerate before you actually cancel your policy. This is called price optimization. They know exactly when your policy renews, they know how busy you are, and they calculate the maximum amount they can extract from you without triggering you to shop around. This brings us to the psychological component of the trap. Why do they get away with this? Because they rely on the lazy tax. The lazy tax is the premium you pay for avoiding inconvenience. Life in 2026 is exhausting. You work all day, you come home, you have to cook dinner, deal with the kids, pay the bills, and try to get 6 hours of sleep before doing it all over again. The absolute last thing in the world you want to do on a Tuesday night is spend 3 hours on the phone with a customer service bot, listening to elevator music, trying to decipher the difference between comprehensive and collision deductibles. The insurance companies engineer their cancellation processes to be as frustrating, confusing, and time-consuming as legally possible. They want you to look at that doubled premium, feel a moment of anger, and then sigh, throw the paper on the counter, and let the autopay do its job. They are monetizing your exhaustion. Every time you hit autopay without fighting back, you are voluntarily funding the CEO's next yacht. You have to stop accepting this. You have to stop treating these bills as fixed laws of nature. Your car insurance is not a tax. It is a negotiable contract. And right now, you are losing the negotiation because you refuse to step up to the table. If you want to survive the financial meat grinder of this decade, you have to become ruthless with your outgoing cash flow. You cannot control the Federal Reserve, you cannot control the price of groceries, but you absolutely can control how much money you hand over to an insurance cartel. In the next part of this deep dive, we are going to start the counterattack. We are going to break down the exact levers you can pull to slash that premium by 30 to 50% in a single afternoon. We are going to talk about the magic of the high deductible, the secret discounts they hide from you, and the psychological warfare you need to use when you finally get a human being on the phone. It is time to stop the bleeding. Now that we have diagnosed the scam, now that we understand you are being targeted by an algorithm designed to extract maximum profit through your exhaustion, we can begin the counterattack. The goal here is not to just complain. The goal is to keep your hard-earned money in your pocket where it belongs. I want you to grab that renewal notice, sit down at your kitchen table, and get ready to do some deeply uncomfortable, highly profitable work. We are going to perform financial surgery. The very first lever we are going to pull is the most powerful one, but it is also the one that scares people the most. We are going to look at your deductible. The deductible is the amount of money you have to pay out of your own pocket before the insurance company pays a single dime toward a claim. Most people, because they are inherently fearful and financially fragile, set their deductibles as low as possible. They want a $250 or a $500 deductible. They think they are buying peace of mind. What they are actually buying is the most expensive, mathematically illogical product the insurance industry sells. Think about it like a casino. The insurance company knows that the vast majority of drivers will never file a major claim. But they also know that fender benders, cracked windshields, and stolen catalytic converters happen every day. These small claims cost the insurance companies an absolute fortune in administrative overhead. They hate small claims, so they charge you an exorbitant, punishing premium for the luxury of having a low deductible. If you have a $500 deductible, you are basically prepaying for your own minor accidents every single month through higher premiums. Here's the tactical move. You are going to raise your deductible immediately. You are going to raise it from $500 to $1,000. If you are a safe driver and you have a solid emergency fund, you are going to raise it to $2,000 or even $2,500. Doing this one simple thing can instantly slash your monthly premium by 15 to 30%. Now I can hear the panic setting in. You are thinking, Ben, what happens if I get into a wreck? How am I going to come up with $2,000? This is where your overall personal finance strategy intersects with your insurance strategy. This is why I constantly preach the necessity of the FU Money Fund, that 3 to 6 months of living expenses sitting in cash. You use that cash pile to self-insure against the small stuff. Insurance should only be used to protect you against catastrophic, life-altering financial ruin. It is there for when you total a $90,000 Mercedes or when a tree falls and crushes your roof. It is not there to fix a scratch on your bumper. You take the risk of the small damages upon yourself, you keep the cash in your own high-yield savings account earning interest, and you stop paying the insurance company a premium to hold your money for you. By raising the deductible, you transition from being a fearful consumer to a calculated risk manager. The second lever we need to pull requires you to look out your window at the car you are actually driving. The insurance industry sells two main types of coverage for your vehicle: comprehensive and collision. Collision pays to fix your car if you hit something. Comprehensive pays to fix your car if a tree falls on it, or if it gets stolen, or if it catches on fire. If you are driving a brand new car with a loan from the bank forces you to carry full coverage. But if you are driving an older paid-off car, carrying full coverage is often a mathematical trap. Let us say you drive a 2014 Toyota Camry. It has 130,000 miles on it. Kelley Blue Book says it is worth roughly $5,000. The insurance company is charging you an extra $800 a year just for the collision and comprehensive portions of your policy. If you keep that car for 4 more years, you will have paid $3,200 in premiums to protect an asset that is depreciating toward zero. And here is the kicker: if you actually get into a wreck, they are not going to give you $5,000. They are going to subtract your $1,000 deductible, they are going to find every scratch and dent to lower the payout, and they will probably just write it off as a total loss and hand you a check for $3,000. You are spending thousands of dollars to protect thousands of dollars. It is a terrible return on investment. The strategy here is ruthless pruning. If your car is paid off and the actual cash value of the vehicle is low enough that you could realistically replace it using your emergency fund, or by taking the bus for a month while you save up, you need to drop collision and comprehensive coverage entirely. You drop down to liability only. Liability is the legal requirement. It pays for the damage you do to the other person's car or body if the accident is your fault. It protects you from getting sued into bankruptcy. You absolutely must carry high liability limits. Do not skimp there. But stop insuring the metal box in your driveway if it is old and cheap. Dropping full coverage on an older vehicle can easily cut your overall bill in half. The third lever is the one they actively try to hide from you: the hidden discounts. The algorithm is designed to punish loyalty, but it is also legally required to offer discounts if you force the issue. When was the last time you actually looked at your declarations page? Are you getting the low mileage discount? Since 2020, millions of Americans transitioned to working from home, but they never told their insurance company. If you are driving 5,000 miles a year instead of 15,000, you are in a lower risk bracket, but they will keep charging you the commuter rate until you demand the change. Are you getting the defensive driver discount? In many states, taking a 4-hour online course for $30 will legally compel your insurance company to lower your rate by 10% for 3 years. Are you bundling your auto with your renter's or homeowner's insurance? Do you have an anti-theft device installed? The insurance agents will not proactively apply these discounts. They are not your friends. They are order takers for the corporation. You have to hunt these discounts down, list them out, and force the agent to type them into the system. Now you are armed with the strategy. You know to raise the deductible, you know to evaluate dropping collision coverage, you know to demand the hidden discounts. But knowing what to do is useless if you do not know how to execute it. In the final part of this deep dive, we are going to go into the trenches. I am going to give you the exact word-for-word script to use on the phone with these companies. We are going to talk about how to pit them against each other in a bidding war for your business and how to weaponize your willingness to walk away. You have the strategy. You understand the levers of deductibles, coverage limits, and hidden discounts. Now it is time for execution. It is time to pick up the phone and play the game. But you cannot go into this battle blind. If you call your current insurance company right now, angry and unprepared, you will lose. They have trained negotiators on the other end of the line whose only job is to pacify you, offer you a pathetic $5 a month discount, and get you off the phone. We are going to bypass that completely by using a concept called the threat of defection. Before you dial your current provider, you must arm yourself with alternative quotes. This takes exactly 20 minutes online. You go to 2 or 3 major competitors. If you have Geico, you get quotes from Progressive, State Farm, and a local independent broker. You plug in the exact same parameters we just discussed: the higher deductible, the adjusted coverage limits, the accurate annual mileage. You get those numbers printed out or saved on your screen. This is your leverage. You cannot negotiate without leverage. If you tell your current company they are too expensive, they will shrug. If you tell them you have a written quote from a competitor for 40% less, they will panic. Now, you call your current provider. You bypass the automated system by hitting 0 until a human answers. When the agent gets on the line, you do not yell. You do not complain about inflation. You use a cold, calculated, professional script. You say this exactly. Hello, my name is Ben. I have been a loyal customer with you for 5 years, and I have a clean driving record. I received my renewal notice, and the premium has increased to an unacceptable level. I have just pulled competitive quotes from Progressive and State Farm for the exact same coverage, and they are offering me a policy for $150 less per month. I would prefer to keep my business here, but I cannot justify this price difference. I need you to review my policy, apply all available discounts including low mileage and defensive driver, and match this competitor's rate. If you cannot do that today, I need you to transfer me to the cancellation department. Let's break down why this script is so powerful. First, you establish your value as a low-risk, loyal customer. Second, you state the problem factually, without emotion. Third, you introduce the competitor by name, proving that you have already done the work. You are not bluffing. Fourth, you give them a clear path to keep your money by matching the rate. And finally, you drop the hammer, the threat of the cancellation department. In the insurance industry, the cancellation department is actually called the retention department. These agents have special authority, secret discount codes, and override powers that the frontline customer service reps do not possess. Their entire bonus structure is based on saving accounts that are about to leave. When you get transferred to retention, you repeat the script. You hold your ground. If they say they can only knock off $20, you say, I appreciate that, but it doesn't bridge the gap. Can we look at raising my deductible to $1,000 to see how that impacts the quote? You make them do the math while you wait on the line. You force them to build a policy that fits your budget, not their profit margin. If they match it or get close enough that it isn't worth the hassle of switching, great. You just saved yourself hundreds, maybe thousands of dollars for 30 minutes of awkward phone time. That is an hourly rate of a corporate lawyer. But what if they say no? What if the algorithm has simply decided that your demographic in your zip code is too risky and they refuse to budge? Then you execute the final step. You walk away, you hang up the phone, you go to the competitor's website, you buy the cheaper policy, and you cancel the old one. Do not feel bad. Do not feel a false sense of loyalty to a corporation that sees you only as a row on a spreadsheet. They would drop you in a heartbeat if the algorithm told them to. You owe them nothing but the premium for the days you were covered. This entire process, auditing your coverage, getting quotes, and negotiating, is a microcosm of surviving the 2026 economy. The era of passive consumption is over. You can no longer set your bills to autopay and assume you are getting a fair deal. The system is actively designed to boil you alive slowly, like a frog in a pot of water, increasing your expenses incrementally until you are completely broke. You have to jump out of the pot. You have to become financially aggressive. Your money is your life energy, and every dollar you save on a bloated insurance premium is a dollar you can use to buy assets, build your emergency fund, and buy back your freedom. I am Ben. Stop complicating it. Start getting free.